Good morning and welcome. Thanks for tuning in to another one of our webcasts, your chance to ask questions to our CIO. I'm George Mitten, investment writer here at Nutmeg. As usual, I have James McManus, Chief Investment Officer, here at the other end of the line. He's going to give a short presentation which looks this week at what's been happening in the oil markets. As you might have seen, according to some measures, the price of oil has recently gone negative, which means you can actually get paid to fill up your car with petrol. Well, no, unfortunately, it doesn't work quite like that. I'm looking forward to hearing from James exactly what this strange negative price actually does mean and how we as investors are likely to be affected. We'll then move into the Q&A session. As ever, if you've not submitted a question yet, or if something occurs to you while James is speaking, pose it to us using the Q&A feature here on Zoom. We'll try to answer it today, and if not, we'll put it on the list for next week. This webcast is being recorded and will be available to watch again if you like. You'll also be able to share the link. Just a quick note to say it's UK FinTech Week this week. At Nutmeg, we're taking the chance to draw attention to the great work of our engineers. You might not know it, but at Nutmeg, something like half of our employees work not on the investment side, but on our code, product, website, app. We'll be publishing some posts by our engineers on our blog, Nutmegonomics, and also letting a couple of our engineers take over our social channels for a day to give an insight into their typical routine. On the topic of innovation, one of the things we're particularly happy about at the moment is our recent integrations with Yolt, Emma, and Money Dashboard, part of our implementation of open banking. I recently set myself up with one of these services, and it now means I can see all my bank accounts, credit cards, and now my Nutmeg account in one place. It's a really useful way to get an overview of your money, and hopefully might help me with some sensible budgeting and planning in future. We'll see if that really does happen. If you're a customer of any of these services, look for Nutmeg in the list of partner providers. That's Yolt, Emma, or Money Dashboard. Or if you haven't tried any of these services yet, now might be a good time. I'm aware that we're talking to an audience that's a mix of Nutmeg customers and those who aren't yet a customer. If you've indicated that you're in the latter category, my colleague Cully Samra would be happy to speak to you personally to answer any questions you might have. That's enough from me. It's time now to introduce James. Over to you, James.
Thanks, George, and good morning, everybody. Thanks again for joining us on another Wednesday morning webcast. And as always, thanks for trusting Nutmeg to manage your investments and being a customer of Nutmeg. Here's today's agenda, a few more slides than recent weeks, given what's been going on in the past 5 days. So firstly, we'll have a quick update on some of the major stories from the past week at a very broad level. And then we'll look at the major story, which is what has been going on with the oil price. As you may have heard and seen the headlines, there's a lot of movements in the oil market this week. So worth touching on exactly what's going on there. And then, of course, we'll move to answer more of your questions. And thanks again to those of you that have sent in questions in advance. So let's get straight to it. Another busy week and another week with some really historic moves for certain asset classes. On the whole, though, from an equity market perspective, quite a muted week, really, since our last webcast last Wednesday. Global equity markets down around 3.7% over that period, led by the US and Europe. The UK, meanwhile, has actually held up a little bit better over the past week, despite its energy component. UK stock markets down around 2.5%. And Japan and Asia stock markets have really led, down around 1.8% and in line with the performance of emerging market stocks over the past week. Alongside that, we've seen US Treasuries move back towards their all-time lows in yields, which is good for prices, meaning positive returns for investors there. And whilst we also saw gold saw muted losses of around 2% in the last 5 days. But the major story of the week has to be in the commodity markets. We talked last week about the supply cuts that have been agreed in the oil market, how they weren't likely to do enough in the near term to stop the production glut of oil that the world faced. And this week we've seen prices fall to new lows, particularly in the US. And in fact, we've experienced negative prices in the oil market for the first time ever in history. And I'll come on to talk about what that means shortly. Away from market performance itself, we're seeing many nations in Europe and across the globe begin to talk about normalization from the lockdowns that they have in place at the moment. Clearly lockdowns have to end at some point, but the medical success at the moment is really being driven by the extent of that activity stop. So we really expect there to be quite cautious progress here near term, despite the optimism. Governments are acutely aware that given the reproductivity of the virus, moving too fast in opening up their economies does risk going back to square one, and second wave infections, as we've seen in Singapore, really do remain the tail risk. But it is a positive driver in terms of sentiment, and we're hopeful that cautious progress can really yield good results. In emerging markets, we've also seen an important announcement from the G20 on debt relief for lower income countries. And this is really important because many lower income countries have limited resources, both medically and policy-wise, in their ability to fight both the economic and the human cost of the virus. And many of these economies are going to be hardest hit by the economic shutdowns. Where there is going to be a deeper human cost is where there is little socioeconomic support in place. And that really could be quite sobering. Many of the lower income economies are really going to struggle much more than developed market economies to adopt a sort of work from home practice. And there's also going to be a lot less fiscal ability to support those economies. So, temporary respite on their debts is going to be really welcome to free up some capital for those countries. The G20's also asked private creditors to get involved in that endeavor. That's going to be a much tougher sell, and at the moment it looks like they're struggling to get private creditors to buy into that program. But I think we will expect further debt relief for low income and emerging market countries to come through in the coming months as conditions worsen there. We've also seen further funds announced in the US for the small business lending programs after these were exhausted last week, and in the UK we're continuing to see further packages of support for additional areas of the economy. For example, there was one launched for a startup rescue package in the past week. And I think here what we're probably going to see is continued stimulus, but we're also going to see lots of headlines around the politicization of this. So, who is and who isn't eligible. We've seen it in the UK in terms of Premier League football clubs. We're seeing it in the US now with some of the major university institutions such as Harvard having to make commitments over how they're going to spend that money. And then bigger chains, one of the big fast food chains has also had to potentially give up some of its support package that it took from the small business lending program. So I think that will become increasingly politicized, but it's good news on the policy front that we continue to see more support coming through. And then finally, earnings season has begun for non-financial companies. So we had the start of the bank's earnings season last week. Now we've got non-financials coming through, and so far it's a bit of a mixed story, really. A couple of highlights from the last couple of days. Consumer staple Coca-Cola, they've witnessed declining sales, down around 25% in April. So quite a big number as the hospitality sector has been shuttered in the developed world. IBM reported falling sales, also withdrawn their financial guidance for the rest of the year due to uncertainty. But on the flip side, we're seeing businesses whose business model actually lends itself to this sort of environment doing quite well. So yesterday we saw Netflix come through with some huge growth in user numbers for the first quarter, acquiring almost double the number of users they expected to in the first quarter of the year. So some positives, some negatives from the non-financial sector. We expect to learn a lot more over the coming weeks as we really get into the thick of the earnings season. Okay, so on to the major story of the week, and really another historical moment in markets in 2020, the first time that the oil price has ever traded at a negative price. And so what's really been happening here? Well, I think the starting point is to understand that there isn't really just one oil price, or there isn't just one oil price. In commodities markets that offer physical delivery, that is that you are buying a physical quantity of a commodity to be delivered at a set date. In essence, what you are buying is a contract for delivery on a certain date. So when we refer to an oil price, we're most commonly referring to the front month future. And that is a term for the futures contract for delivery at the nearest expiry date, the date at which you'd have to take delivery of that commodity, which is typically a month or so, or less even away from today. Now, there are actually many different types of oil, and but primarily markets reference two types, and that's Brent crude and WTI, or West Texas Intermediate, as the reference oil prices. So roughly 2/3 of all crude oil contracts in the world reference Brent crude, making it by far and away the most widely used marker. However, in the US, it's actually WTI that is the benchmark price, the West Texas Intermediate. And that refers to oil that's extracted from wells in the US and it's sent via pipelines predominantly to a place called Cushing in Oklahoma. And the fact that supplies are landlocked in the US makes WTI very different from Brent crude, where the supplies are typically not landlocked. They're typically based either at sea or can easily be shipped around the world. And the products themselves actually differ in terms of their composition. So WTI, for example, is a very light and very sweet type of crude oil, and that makes it ideal for making gasoline, in particular, making petrol. Brent crude from the North Sea also tends to be a good input product for gasoline. But there's other types of oil and crude oil that are found around the world, including in the Middle East. So it's really important to understand that there are different prices for different types of oil and also different delivery dates. And I think here it's really important also to understand that, once upon a time, the oil market was based purely on physical delivery. That is, that you would pay the current price and then you would accept the delivery of the oil shortly after that. But actually in the 1970s, we went through an oil crisis, and after that, buyers and producers themselves wanted to reduce the risk that near-term spikes in the price of oil would have. And that's when a futures market was created. So what a futures market allows you to do is to buy contracts between buyers and sellers that lock in prices for delivery in the future. And that does make the market a little bit more complex to understand, but hopefully I can try and distill that to you in a bit more detail today. And that wasn't a pun using distill there. So what's happened this week? Well, in simple terms, the COVID crisis has really shut down a lot of demand for oil, and the shutdowns that we've seen globally have seen a gigantic demand slump in oil markets, and that really has a couple of primary effects. So the lack of demand has really caused storage facilities in the US in particular to begin to fill up. And investors are beginning to worry that actually we might reach capacity for storage of WTI oil, so West Texas Intermediate. And higher inventories generally reduce prices because that means there's more oil available in the first place. And that also can be worrisome in terms of inventory growth, because oil rigs can't simply just be shut off. Often closing down oil production is going to cost a lot of money. And Brent crude itself, or crude oil itself, is quite a dangerous and a difficult product to store. So there aren't many solutions to the problem of storage filling up in the near term outside creating more storage facilities, which is a more of a medium-term solution. And this chart shows you the rise that we've seen in inventories. This is the Department of Energy's crude oil total inventory data. And you can see the spike that we've had in 2020 and how inventories have risen quite significantly since the beginning of the year. Now, the other major effect that near-term demand evaporation has is that near-term prices for oil or delivery of oil nearer term have fallen more than the prices for oil for delivery further out. And that's because we expect demand to come back once the lockdowns are over. So this should, in theory, be a relatively temporary impact where demand increases over time as the economy recovers. And actually, therefore, we see the oil price increasing. And this is what this curve shows you on this slide, the nearest date for delivery having the lowest price. And as we move further out in time and further out even through to 2025, 2026, the curve is predicting a higher oil price. Now, this has a technical term actually called contango in commodity markets. And contango means that current prices are lower than future prices. And that's actually quite typical of commodities markets if you believe that the prices of commodities are going to increase over time. And again, you can see that in the curve of the chart. But this also has an impact on investors, particularly those investors who are investing in oil funds. And this is because those funds tend to invest in the front month future, so the nearest delivery date future. And each month, to avoid taking delivery of the physical oil, what they do is they roll that future to the next month. And this adds selling pressure itself to the nearest price, but it also means that potentially there's losses there for investors. So if you're selling contracts at much lower prices before buying next month contracts at higher prices, unfortunately, that's going to result in a loss for you. And so the steepness of this curve and the steepness of the contango we're seeing at the moment means that, unfortunately, for many investors in oil funds, they are going to suffer steep losses as those funds move their positions out to the next month futures. And we're beginning to see that unwind at the moment. All of this taken together means that the front month future, the nearest delivery date contract for WTI in May, really witnessed a historic move earlier this week when the price for May delivery plunged through that combination of a lack of near-term demand, the selling from funds, and then also a lack of storage facilities. And you can see the plunge in the price there, and in fact it going to a negative oil price for the first time. And it's worth noting that this came at a point when the futures contract was due to expire. So in other words, investors who hold the contract would have to accept delivery of the physical commodity. So at one point, the price of WTI turned negative, and that really reflected the fact that investors were paying for others to take the oil off their hands before they had to accept physical delivery. And that's something we've never witnessed before in the oil market. I think it's worth also noting that the oil price slide hasn't just been limited to WTI. So this is the price of Brent crude. The previous slide showed you the price of WTI, the US benchmark. Brent crude is the global benchmark, as we discussed before. And you can see that slight tick up earlier in the month as the supply cuts were expected. But actually what we've seen is the oil price continue to fall and to push much lower than it had done previously at the beginning of April or the end of March, reaching a point now where the demand slump is really feeding through to all oil prices and not just isolated in WTI. So what does this mean for investors? Oh, I'm a little bit too far there. What does it mean for investors, and what does it mean for Nutmeg portfolios? Well, we talked before about the sort of positive and negative impacts here, depending on whether you're a consumer or a supplier of oil. Falls in price really turbocharge consumers' pockets. They act like a tax cut, but they're also really worrisome for suppliers, for nations and companies that rely on those oil revenues to survive. And so I think it's worth just revisiting, what does this mean for our portfolios and what does it mean for different types of assets? Well, I guess first, we don't invest in oil directly in any of our portfolios. We don't invest directly in any oil-related ETFs or in fact, even in any commodity-related ETFs. So that limits the scope of being caught by this sort of brutal movement in oil. We have regularly reviewed the commodity ETF landscape, but it's never really interested us, and we've never invested in any beside really the physical gold strategies. And the complexity of the structures and the fact that many of these are derivative-based and the complications I talked around the idea of contango, where actually if you have a positive view on the oil market, the structure of the fund investing itself, meaning it needs to roll to the higher, more expensive contracts, means that actually even if you have a positive view on the asset class, you can lose money. Those ongoing rolling costs don't appear attractive or viable to us, and that's one of the reasons we've never invested in oil ETFs. But we do have indirect exposure to oil via many other instruments. Oil is a key input into the global economy, and therefore through our equity and fixed income exposure, we do have some level of exposure indirectly to the oil industry. In equity ETFs, energy-related stocks are a much lower portion of what they were 10 years ago. And actually energy stocks tend to suffer when the oil price goes down, as they would as they're reliant on energy revenues. But actually many other components of the wider equity market actually benefit because they're consumers of cheap oil. So in the equity market as a whole, globally, it's actually a much more balanced picture than you might expect. On the fixed income side, in high yield bonds, we talked before about the energy component here, around 13% of the index back in February, and in particular the impact on shale producers. The price decline here in the short term for WTI is also going to be troublesome for them. But I think it is worth focusing on the medium term demand expectations, and the expectation that we do have a demand tick up as the economy recovers, and therefore, is the price at this point any meaningfully more damaging to many of those producers than it was a couple of weeks ago? Arguably not, but clearly, erratic movements in the price of oil are going to be troublesome for those types of businesses. I think another interesting area to think about is EM debt, and we've got a chart here that shows you the top 20 nations ranked by oil profits as a percentage of their GDP, and that's of the latest data as of 2017. The price of oil really does have an impact on the ability of some emerging market countries to repay their debts, especially when those debts are in US dollars. This is something that we've been reflecting on in our assessment of the asset class. I think it's quite interesting, the dynamics that we've seen at play here. The size of oil producing countries in the EM debt universe has actually doubled in the past 5 years, and the countries with a really high external debt burden that are relying actively on oil revenues and oil export are going to see further difficulties to pay some of their future liabilities, and that's a consideration we have in terms of the total risk of our portfolio and our positioning when it comes to emerging market debt. I would say here, bear in mind the Brent crude price hasn't moved anywhere near as much as the WTI price. So the oil price, negative oil prices we've seen really have been a US oil market focused issue. And then I suppose lastly, we do manage a range of socially responsible portfolios as well. And this is something that we've started to integrate within our wider fully managed portfolios. So if you're a fully managed portfolio holder, you will have noticed that we have exposure to, particularly in the US, but also global equities, the socially responsible products. They have a much lower carbon intensity than the wider index. We think the price of oil has actually had quite a strong impact this year on the excess return that's been generated by some of the socially responsible portfolios and some of the individual socially responsible indices. We think socially responsible investing, the ESG aspects are really going to become a crucial factor going forward. And what's happening in the oil market right now is in some ways a good reflection of that, and is only going to benefit ESG investing trends further. So what happens next after this for the oil price? Well, as I said, medium term, demand should return as we normalize economies, but that really depends on the speed of the recovery. And we could see further declines in prices for the near-term delivery in June, July, and August. But we also are likely to see OPEC plus nations take further action to support the oil market, either through further production cuts or through other means. And it's likely also that we'll see the US seek to support its internal oil sector, given the job growth that they've seen there in the past 10 years. So that's a whistle-stop tour of what's been going on in the oil market. And with that, George, I think we'll move on to Q&A.
Thank you, James. So when you've been contangoed. I have to say, when I first discovered the term contango, I don't think you mentioned the opposite term, which I understand is backwardation. When I first encountered these terms, backwardation and contango, I wasn't sure if I was reading a sort of spoof article of made-up words, but as you've just attested, they genuinely are the words that are used in the commodity market. So I find that fascinating. Contango and backwardation. Okay, so let's move on to the Q&A. So we have a question here from Eugene, who wants to know how our low-risk portfolios work. Eugene asks, I'm worried about the safety of my funds and have chosen your lowest risk level. Can you tell me how my funds are safer at this low risk level, James?
Yeah, so each of our risk levels is graded by risk. What does that mean? It means the portfolios are anchored to a long-term volatility level. So for our lowest risk portfolio, that would be a volatility level of around 2% in the long term, and that compares with a volatility level of around 3% for the next risk level up, and a portfolio volatility level of over the long term of around 8% for a medium risk portfolio such as a Model 6. So because it's a much lower risk portfolio, it will contain assets typically that have had the bulk of the assets in the portfolio will be fixed income assets that have historically had much lower risk profiles. and particularly fixed income assets with very short-term maturities. So it is a very low-risk portfolio. It carries less risk than its strategic asset allocation at the current time as well. So the portfolio has quite a low duration, which is an interest rate sensitivity compared to our longer-term allocation. And we're also at the moment running that portfolio, the portfolio level risk one, at an expected long-term volatility of around 1%. So about half the risk that it would typically expect to be over the long term. Now, I would say it's already a very low level of risk. 2% volatility is very low to start off with. But at low bond yields at the moment, bond portfolios are going to tend to experience higher volatility for the sort of same change in yields. So historically, bond yields have been much higher and falling, and therefore bond portfolios may not have experienced the same level of volatility as they may be exposed to going forward. And when we've seen volatility spike in asset classes outside of the norm, it makes sense to think about the volatility component of that portfolio. And for us, we're quite comfortable at the moment with the way that portfolio is positioned. It tends to buy very short-term money market instruments. About 80% of the portfolio is invested in short-term money market instruments. They are considered amongst the sort of safest and most liquid of credit instruments, corporate bond instruments, investment grade rated, and typically with a maturity of much less than 5 years. So it is a low risk portfolio. It's being run at lower risk than we would typically expect to do so over the long term. So I hope that answers the question.
Thanks, James. And continuing the theme of bonds, I just want to clarify, this will be probably obvious to many of our viewers, but when we say fixed income, we typically mean the same as bonds. Fixed income and bonds, we often use the terms interchangeably. So on the theme of bonds, we have another question from Jeremy, who asks, I would be really interested to know your view on the future of bonds, the future role of bonds, both government and corporate. QE, or quantitative easing, known informally as money printing, and the other vast central bank activity that's going on at the moment must have changed the role of bonds in portfolios and hence their risk, suggests Jeremy. Jeremy wants to know, is a portfolio split between 20% equities and 80% bonds really less risky than the opposite, a portfolio of 80% equity and 20% bonds? And what does this mean for those in retirement? So here we have a question about the future role of bonds, James.
Yeah, so thanks for the question. That's a really interesting one. And I think as we've covered in recent weeks, government bonds in the US and the UK have performed quite well in the volatile market conditions we've seen. Over the past couple of months, as investors have sought safe haven style assets, and the central banks in the Western world have launched huge programs to support asset markets. I think shorter term, we expect bonds to continue to act as a safe haven for investors. And as the question, I think rightly states, that the expectation of buying from central banks such as the Federal Reserve and the ECB is really going to keep bond yields anchored towards their lows in the short term. Looking ahead to the medium-term future, I think we'd expect government bonds, especially treasuries and gilts, to still form part of investment portfolios despite the lower return expectations. Yields on US government bonds in particular are now back down to their all-time lows. Not surprising given the unprecedented situation we face, and economically, but also in terms of the level of stimulus. And so returns are potentially materially lower than they have been historically going forward. And because bond yields are so low and prices work inversely to yields, if yields were to rise, that means that bondholders would suffer losses. And as I mentioned earlier, in the earlier question, right, when yields are lower to begin with, smaller moves then are going to cause greater volatility. So, I think in terms of spending, ordinarily the level of fiscal spending that we've seen announced would give really some significant cause for concern in terms of higher yields. But I think that a large portion of that has come as a component that is consisting of deferrals. So it's not necessarily immediately adding to the debt burden. And I also think that in the US, the extent of central bank purchases is really going to keep a lid on yields for some time to come. The Federal Reserve has made a historic pledge of unlimited purchases, and as the old saying goes, you don't fight the Fed. The Fed is the marginal buyer. It's expanded its balance sheet from around $1.8 trillion to $6 trillion in a matter of weeks. So it's a really significant impact on the market, and that is probably going to keep yields relatively anchored. But medium term, we think it is it's sensible to believe that yields are going to move higher. After all, they are being driven to their current lows by quite an extreme event and also quite an extreme policy response. But I think it's also worth bearing in mind that, as we saw in the 10 years since the financial crisis, it's much easier to implement quantitative easing than it is to unwind it. So it's much easier for the central banks to buy up all these securities than it is for them to unwind that buying. And it's really going to take some time after this for the Federal Reserve to get comfortable with materially raising interest rates again and push yields higher. So we also think it's likely that we'll see yield curve control. I think we touched on this in a previous webcast. Target levels for yields that are set by the Fed that then limit the degree to which yields can actually rise. So, lots of reasons to believe that yields could stay lower for the medium term, for short medium term, I should say. We still think government bonds, offer some real value from a diversification perspective. We know that market downturns and recoveries are far from linear. And so bonds are going to retain a place in portfolios from a diversification perspective. But one of the reasons we are holding more cash than usual at the moment is precisely because bonds appear sort of relatively expensive on a historical basis, given that they're towards their lows in yields. And that's why we have slightly less interest rate sensitivity duration in our portfolios at present, because we want to protect against the probability that yields do move higher at some point. But we think materially in the short term that there's a lot of anchors to believe that we're going to have a lower for longer interest rate environment.
Thank you, James. As usual, we've had several questions about market timing. Josh, Charlie, Angelica, Peter, and others have given us questions about this. I'm going to read out one, which comes from Charlie. It's almost an offensive question to ask in current circumstances, but if you are in the fortunate position of having recently received a large sum in the region of £75,000, and you can take a reasonably long outlook of 5 or more years, would you wait in cash for now or start going back into the market? What's your thoughts, James?
So I think we had a very similar question to this last week. So maybe a bit of a theme here. I think the honest answer is it is entirely a question of preference, but there are arguments for and against investing in one lump sum. If you're investing for the long term, then you might want to contribute, the whole amount at the beginning of the period. So what does that mean? It means at the moment you are taking advantage of a global stock market that is 18 to 20% lower than where it was 2 months ago. But you also, if you're doing that, you also have to recognize that markets could fall further in the short term, and that you're placing a lot of emphasis on that one entry point, particularly if you're in the lucky position that you have a sum of sort of 75,000 to invest. But investing in one lump sum clearly maximizes the amount of time that you have to earn compound interest over the long term, and that's the returns that you earn on top of returns and not just on top of the initial money that you invest. The alternative route would be to think about a strategy that we call pound cost averaging, which is spreading out the investments over time to average the entry point into the market. And what does that mean? It means that your money is going to be out of the market for longer. It's going to have less time to earn compound interest, but it's also going to be less reliant on that initial investment date in terms of determining your returns in the short term. So there is an element of this that it comes down to the investor's preference. We do have a great blog on this. I think I've mentioned it before in Nutmegonomics. It's called The Early ISA Investor Gets the Returns. If you're interested in reading more on that topic, please do go take a look at that blog. It includes a number of examples, and it really looks at the effects of compounding versus the effects of spreading out payments over time in different market conditions.
Thanks, James. Now, just to follow up on that one, you gave a good explanation there of the difference between a lump sum and pound cost averaging. What about simply staying in cash for now? What do you think of that compared with the other two options?
So, we don't encourage market timing. I don't move my investments to cash at any point. You should be focused, I think, if you're investing on an investment goal, and be committed to that goal and be committed to the time frame that you have initially set up the investment for, unless something has materially changed and therefore maybe it's appropriate to change that time frame or that risk level. When it comes to cash itself, rather than investing right now, I think calling the bottoms and the tops in markets is clearly incredibly difficult. But what we do know about sitting in cash is that there is a cost of inflation into doing so, and that's really an underestimated cost by many individuals. Interest rates are incredibly low in the Western world. That means you're unlikely to earn an interest rate that offsets the current level of inflation. And whilst inflation is falling somewhat at the moment, when we see the economic recovery come through, that will be eventual, that we're going to see a pickup in inflation as well, likely. So, inflation really does erode the buying power of your money over time. If you think about inflation having averaged around 2% in the UK, in recent history, that's 2% a year of your money that is being eroded in terms of buying power, unless you're earning more than 2% on it. And the only real way to do that at the moment is going to be in an investment itself rather than in cash, I'm afraid. So for me, the opportunity cost of sitting in cash is not that attractive. But again, investors need to consider their own circumstances when they're coming to making these decisions.
Thanks. Thank you, James. That was very helpful. Okay, next question. This actually came in during last week's webcast, but we didn't have time to answer it then. It came from a user named Unimatrix0. I think this user's name may be Patrick, but correct me if I'm wrong. The question is, given the market devastation of COVID-19, what further impact do you feel Brexit will eventually have? James?
Okay, well, that is really quite a big question. It's probably too big a question to answer briefly on the webcast, but I'll give it a go. And I think there are, as a starting point, there are still many unknowns when it comes to the eventual outcomes of Brexit. And I think, in fact, there have been so many twists and turns in this story over the previous 4 years that predicting the outcomes with any certainty has become a little bit of a fool's errand. But when it comes to Brexit, we at Nutmeg prefer to focus on actually what we do know, rather than sort of speculating on what outcomes potentially will be. So, what do we know at the moment? Well, we know the timetable that's been put forward for the deal negotiations was time constrained to begin with. We know it's now fallen behind schedule, but we think it might still be achievable. We also know that the current UK government won a really clear mandate to enact Brexit back at the end of 2019. They've also promised a date of December this year for the UK's departure. Now, the official government position at the moment is that the current transition period will end at the end of this year, and that negotiations over the future trade arrangements will be concluded, or otherwise, the UK is going to leave, or Britain, I guess, is going to leave, and it will trade with the European Union on World Trade Organization terms. We also know, though, that the impact of coronavirus on the global economy has been severe, and that makes any move to simply leave and trade on WTO terms, a hard Brexit as it's known, much riskier at this point than it would have been maybe a year or so ago. So you have to have bake some level of probability into an extension on that basis. So what do we know about an extension? Well, we think an extension is possible, but it's a decision that can't really be delayed. So the UK can request an extension of up to 2 years, but it's got to do so by July. It's going to be ratified by July. And again, here, depending on your political persuasion, I guess there'd be an argument to say that potentially an extension could always come further down the line as well, and that the material impact and change that we've seen coronavirus have, the direct effect that it's had on negotiations, might soften some of these hard lines. But that is where we are today. I think from a political perspective in the UK, coronavirus has had a direct effect on negotiations. The chief negotiators both had to take a period out because of symptoms of coronavirus. That might provide some scope for a limited extension. I think, when you think about the principles of what a transition period is designed to do, it's designed to soften the effects of a move between the trading regimes. And given the current economic environment, and the economic environment we're likely to still be experiencing in a couple of months, few politicians are really going to want to take the risk on further pain with much less room to support the economy than they had before. We also, of course, don't know how long coronavirus issues will last here in the UK, but also in the EU. There are two sides to the negotiations, and there's therefore the likelihood that status quo might become more attractive if coronavirus becomes a prolonged issue. So, lots of unknowns without many solid answers to some of those questions. But I think it's also true that markets have now had almost 4 years at this point to come to terms with the fact that the UK is going to leave the EU. The pound sterling GBP, after all, is about 17% lower now than it was at the start of 2016. And actually, really, what we're seeing with the pound at the moment is it's in the middle of a range that it's traded in against the euro since 2017, and maybe that suggests in itself that there is, the market is hedging its bets, if you like. So I think in summary, it's probably fair to expect that there are going to be a few more twists and turns in the tail. The government is likely the UK government at least is likely to bide its time on the decision about whether to extend or not, because it is a very difficult one politically, given the mandate they received in the election. That's a clear mandate to get Brexit done versus reacting to the extreme damage that's been caused by the coronavirus. So, we're not in the business of speculating, as I said, but it's focusing on what we know. And we'll be looking ahead to the months up to July to understand what government policy and the EU policy might lead to in terms of either an extension or a focus on conclusion of negotiations by December.
Thank you, James. I'm aware that we're running a little bit short of time. I'll ask this one, and we may have time for one more afterwards, but I'll see how long this one takes. This one came in from a previous webcast again. I remember wanting to ask it at the time, but we didn't actually have enough time at that point. We were talking about ETFs, James, and you were explaining why you prefer them to mutual funds run by stock pickers. And the question came in, so how can you outperform an index? So you were talking, I think, at the time about how many of these stock pickers were not outperforming, and that's why you didn't think they were good funds to invest in. Could you explain a bit more about what you mean by outperformance, and perhaps shed some light on this difference between active and passive funds, James?
Sure. So for those that didn't see that particular webcast, we were taking a quick look at the performance of UK active stock pickers. So investors who focus on picking stocks rather than focusing on asset allocation, and then how they performed in the long run on average, and also over the past couple of months, the results of which were comprehensively underwhelming in my opinion. So I think when we talk about passive funds, we're talking about a strategy that follows sort of a rules-based methodology. So I don't really like the term passive because I think it underplays what's actually going on. All of the ETFs in our portfolios have portfolio managers. They use the same technology to manage portfolios as many stock pickers do. But what they're doing is they're following a preset rules-based methodology that determines what they invest in. And the most common and simple example of this is a size-based methodology. So, for example, the manager of a FTSE 100 ETF would buy all of the stocks in the FTSE 100, the UK stock market, according to the methodology of the index that states that you weight them by their relative size. So, That's how you're going to decide their size in the portfolio based on their relative size in the market. But also, passive strategies can be weighted on other attributes as well. So they could be weighted on their dividends, for example, or other characteristics such as their volatility or the valuation. I think on the question of how to perform a stock index, the answer is that on paper at least, it would appear very hard to do that consistently over the long term, particularly when the fees for many stock picking strategies are considered. But I will leave you with a really interesting fact on this, and it's one that not many people know about. And despite the objective of most ETFs to track the return of the market, of passive strategies to track that rules-based methodology, many ETFs actually can provide outperformance of the underlying index through quirks such as tax structures in their legal domicile. So really quick example, the biggest ETF in Europe is an S&P 500 ETF. It tracks the 500 largest companies in the US, weighted by size. Over the past 5 years, that ETF has actually outperformed the S&P 500 by 1.7%. And that's due to a quirk in its domicile of Ireland. Funds domiciled in Ireland are able to get a rebate on the withholding tax that's paid on dividends that leave the US, and therefore the fund's actual performance is much higher than the performance of the index, and therefore the ETF, believe it or not, has actually outperformed the index there.
That's a very interesting example. Thank you, James. I'm afraid we are going to have to end it there. We do have more material that we'd love to cover, but that's okay because we will be doing another webcast next week at the same time. That's 11 a.m. on Wednesday. So if you were one of the people who submitted a question today, and I have seen a couple of questions come in, please do log in next week if you can, or prepare to watch the YouTube video once we've done the webcast and posted it, because we will do our best to answer your questions then. I've previously mentioned on these webcasts Trustpilot. If you have used Nutmeg and if you have enjoyed using Nutmeg, then one way to share that feedback is by leaving us a review. You can find that correct page by searching for Nutmeg Trustpilot. This feedback is obviously helpful for us, but it might help other potential customers on their journey too. And again, I'd like to say that our partnership with Great Ormond Street Hospital Children's Charity is still very much ongoing. This is a great charity that relies on people's generosity to make a real difference to ill children and young people. We at Nutmeg are donating £25 for every junior ISA that is opened with us, and we'll also match any donations you make up to £100. You can learn more about this at nutmeg.com/JISA. Capital is at risk and JISA rules apply. Thank you once again for tuning in, and I hope to see many of you next week, 11 a.m. on Wednesday. Thanks a lot.